Let's say someone's watching this podcast and then they want to do something similar. Like, I want to start buying mobile home parks or any type of commercial real estate. What was kind of the idea of partnering rather than just going on your own to do it?
So his background in private equity, he's excellent with Excel. He knows how to calculate everything, ins and outs and everything. I was more so like the people side, entrepreneurship. With syndicating, with putting together something like this, it's so many concurrent things at once. A hindrance for a lot of people, they're like, look, I don't get how to underwrite it. In reality, it's just like, hey, here's a piece of property. This is a business that you're running. People forget that. It's more so just what gets you comfortable, what gets others on board as well. How do you share that vision and how do you execute on it? You just keep it simple.
If you have the money or you have the ability to save up the money to buy real estate on your own, why go raise money? All right, guys, welcome back. We have a special podcast New Year's Day episode. I have special guest Leo Young. He is one of the owners of Cornell Communities. I brought him on the podcast, so he's actually under contract on Shady Acres Mobile Home Park, which is a 48-unit deal I had listed in Danbury, Connecticut. And interesting thing about him and his partner, so being younger guys in the industry, I thought it'd be interesting to have him on and talk about how he's actually buying this deal, how they raised the money to it, and kind of how they structured that. Because when a lot of us talk about buying real estate deals with no money down or essentially none of your own money, there's a lot of creative options and a lot of different structures you could do. But what's interesting is these guys are actually doing that on a deal that I have listed for sale right now and that they're under contract on. So Leo, thank you for coming on the show.
Thank you for having me. Looking forward to it.
So the first thing that I want to talk about, or the main topic I want to go over, is how you guys structured this deal and how you're raising the money, who's doing what as far as the equity goes, and kind of just that entire experience and how that looks like.
Sure.
But before we get into that, just so the people who are watching this know a little bit about you, what's your history? Give me your kind of rundown, starting from how'd you get into real estate, what's your background, what'd you do before getting into real estate,
Sure.
kind of how'd you work your way to the mobile home park industry to where you are today.
Yep, sounds good. So my background, so I studied finance back in college. I've always appreciated looking deeper into numbers, figuring out, what makes a good deal good. And for me, like, I've always been inquisitive, and so like I kept that in my back burner. So out of college, I actually worked in sales. I worked at Tesla for a couple of years.
Nice.
It was a very enriching experience that I liked a lot. It sort of taught me a lot on just the work ethic, on how to just show up day in, day out, and the importance of sales. So I did that for a couple of years, and then I went into real estate. I started in the residential side as a broker. So did that for a while, expanded to commercial real estate, and then I worked at a real estate fund, an investment fund based in New York. They focus on telecom assets. So did that for some time, and then I linked up with my now partner at Cornell Communities. The funny story about that is, so how we met was through our girlfriends. My girlfriend worked at Citi, and so did his girlfriend. So they roomed together, so we got connected just through random breakfasts. And he told me he was looking to start a real estate fund, like a syndication. So I thought that sounded interesting, and hence how I got into mobile home parks. Because for him, he just got done working at Open Door Capital, which is Brandon Turner's fund. And his fund at the time focused specifically on mobile home parks because of, a variety of factors which we can go into later. But so, long story short, that's how I got into real estate and specifically mobile home parks.
Now, when you were working for the telecom tower group, and you were doing residential, was the residential kind of a side thing on top of that, or was that kind of simultaneously, or were you doing residential then you got into like kind of the investment side of things with the telecom?
Yep. So it was more like a progression. So I started with residential. I got initially into real estate because like I said, I like to think of, why something's good, and I wanted to invest in real estate. I knew that sort of way back when. So I got into residential, and I realized that, like, hey, the investing didn't really make that much sense. It was comp-based valuation versus,
Actual
NOI
financials
and like
driving.
right, exactly.
Yeah.
So I discovered that, and I found the commercial side to be much more interesting to me.
Yeah.
And so I went into it, and then last year I worked for the fund. So until earlier this year, and then now fully doing this.
Yeah.
Yeah.
Cool. And now working with the fund, is that where you learned a lot about kind of the ins and outs of how syndication works and raising money and deal structures work? Or did that come kind of after? Like, what were your roles with the fund and how did that play into the decision
Sure.
to go off and now start buying properties on your own?
Yeah, so at the fund, I was more so working on acquisitions, so helping them source, underwrite, and close the deals, nationwide.
Yeah. So you got to see kind of the whole gambit.
Exactly. So understand like how a fund looks at a deal instead of like how an individual investor would look at a deal,
Yeah.
which sort of helped me in terms of the syndication side because you're effectively putting together a fund,
Yeah.
right? You're pooling together capital, you're buying something, you have investors to speak to.
Yeah.
So that gave me sort of the fundamentals, but a lot of it, I would say like the overwhelming majority was curiosity-based learning.
Okay.
Yeah.
Cool. And then now meeting with, for those of you that don't know, so he's partnered with a guy named Philip Lee, who's another young guy in the industry, and they're the ones that came together and they put together the team now that's buying Shady Acres. I know you mentioned another one down in North Carolina.
Yeah.
So the decision to say, hey, all right, we both work in real estate, or I know Philip Lee works more in private equity, but similar things. It's all funds, buying businesses and cash flowing assets and raising the equity of it. What made you guys decide, hey, let's come together, and then what were the roles you kind of agreed on? Like, and I'm asking this from the point of view of, let's say someone's watching this podcast and then they want to do something similar, like, hey, listen, I want to start buying mobile home parks or any type of commercial real estate. I'm a younger guy, I don't have money to do it. I need to find the right partners to get a deal done and kind of put this team together. When you and Phil came together, what was kind of the idea of partnering rather than just going on your own to do it? I know that might be a complicated question because I know you're figuring it out as you go along the process, right? Because you're under contract, you run into a roadblock. It's like, all right, now we got to figure this out. So maybe the roles change. But what was kind of the initial thoughts?
Yeah. So I think when you're going about entrepreneurship from the ground up, right, which a lot of people are, you have to put in the mindset of to do whatever it takes to get the job done.
Yeah.
So for us, yes, I mean, we sort of had our background, our sort of strengths going into it. So his background in private equity, he's excellent with Excel. He knows how to calculate everything, ins and outs and everything. And he knows the structure of a larger fund, how to operate it. So he has that background. And for me, I was used to working from the ground up, speaking to individual people, working day to day, like different kinds of interactions, like negotiations, whatever.
Yeah.
So I was more so like the people side, entrepreneurship, like sales sort of side, and then he's like the numbers side. So we went into it actually not having clear distinctions of what needs to be, or like who does what.
Yeah.
Because when you're starting something, it's hard to like just define something that you don't know if you're good at.
Yeah.
So we kept an open mind and sort of had that mentality. Just do what you have to do.
Yeah. No, that's good insight because a lot of the times, like advice I got early on. So now, and me and you talked off camera about this, but I'm really focused on brokering now, and I think that's a very lucrative option for the short, like 3-year time span.
For sure.
But when I was thinking about going in the buy side, people are talking about like partner with experts in the different roles that you might lack in. AKA, if you don't have capital, obviously find a capital guy. But like different things as far as like what you're saying, you don't know what roles and shoes you need to fill.
Right.
Until like you're kind of in the fire, so it's like, how do you even decide that? And that was something I got stuck on. I'm like, well, who do I need to partner with? Because as far as I know, like when I was young and dumb, I'm like, I just need a guy who's got $1 million to fund me. But then it's like, well, all right, what does the attorney look like? What does the contract look like? Who's doing the management? Are we going to take a management fee? And then is the management fee? Then we're hiring a manager. It's like there's a lot of ins and outs behind it. And then the capital guy, it's like, how's the capital guy going to get compensated? And there's like a lot of moving parts to it. Any insight?
So I will interject really quickly is that, so when you're going about entrepreneurship, like from the ground up.
Yeah.
So like for me and Phil, like we went about it with a blank slate.
Yeah.
That is a different sort of headspace and mindset compared to if you go into an existing team.
Yeah.
You know, even if they've done like a few deals together and then you're joining them as like the acquisitions guy.
Yeah.
You're going in saying like, hey, look, I don't have capital, but I have time.
Yeah.
I can cold call all day and like I could visit site owners and like make things happen. Okay, then that's a lot more defined. So, you know, for those that want to like start their journey, that want to do something like this, you know, it's helpful to ask yourself like, how much structure do you want?
Yeah.
It's easy to talk about like, hey, you know, you have to be able to handle the uncertainties of entrepreneurship, but it's another thing to live it. And it's a very conscious decision that you have to make yourself to be like, okay, am I okay with like knowing nothing and like figuring things out and like moving forward day in and day out? Or is it like, hey, do I want some guidance? Do I want to go into it? Which, you know, for us, like we've actually done both.
Yeah.
So, you know, for us, like starting Cornell Communities, like that was together, but also like partnering on deals. Like for example, the one in Danbury, like we're not skilled operators and like we don't pretend like we are.
Yeah.
So we partner with someone very experienced to do that. So we know clearly like what each person brings to the table, and you know we're okay to figure things out along the way.
Yeah.
So like have that structure, but also be open-minded that you want to get the job done.
Yeah.
Yeah.
So for viewers, because it seems like I notice this too when a lot of guys that are in the commercial real estate space, syndicators and everything, are talking about deals. We throw around a lot of buzzwords and kind of refer to everything like partners, equity, and stuff. It's like, all right, well, what does that all mean? Like, they kind of dumb this down for like the newer viewers and people that are just trying to get into commercial real estate. So when we say like, all right, they're partnering and they're buying a mobile home park, to give you kind of insight, it's a 48 unit mobile home park, Danbury, Connecticut. Pricing, it's a few $1 million, because I don't want to expose the contract pricing and everything just for the sake of exclusivity, since we're currently under contract. If we close it, then different story. But all right, millions of dollars, and these are two younger guys. They have money, but they're raising money to buy the deal. Here's a good question. So you guys buying this one, right? Did you have capital commitment already before the deal? Or how did that process work? Because I know a lot of guys that are trying to buy a deal with essentially none of their own money. They're like, oh, I need to find like a really rich guy first that's going to fund me and then go buy it. Or do you find the great deal first, put together a plan and present it to a capital guy? Like, what does that process kind of look like?
I love it. That's a great question. Yeah. So a common saying out there is that if you have a great deal, money will come.
Yeah.
That's completely BS.
Yeah.
So a lot of it, well, there's a lot that goes into something, right? I mean, put yourself on the shoe of the wealthy guy looking to invest. Like, okay, well, here's like these two younger guys like visiting me saying like, hey, we have this wonderful deal. Like, hey, look, there's like 15-20% return.
Give me $1 million.
Like, great. Like, do I have any surety of your execution? Like, do you have any track record? Like, how do I know I can trust you? Like, how are you going to run the deal like onwards? Like, how do I know you can operate it? So like there's a lot of unknowns that need to be filled in for any investor to invest in you.
Yeah.
And that takes time. So for us, you know, we've been networking with a ton of people, just ranging from individuals like, you know, friends and family to larger groups, you know, to other people that just have like good connections all over. To, you know, even like family offices, which, you know, we're not sure if it makes sense at this point.
Yeah.
I mean, there's something for everything, right? For each deal, you have to figure out. Like, for example, you know, if there's like $1 million deal, you're raising $500K, that's way too small for like a family office. Versus if it's a $10 million deal, that's a different story.
Yeah.
So I think being conscious about like what deal you have and what the capital requirements are.
Yeah.
That's super helpful, because then you're not running around like a chicken with its head cut off, and you can like strategically go after the capital sources that you need.
Yeah. And then how do you meet a lot of these capital sources, or how do you kind of network with that? And to give you guys a little bit of backstory, so him and Phil are based out of New York City, which is very money financial based. So obviously if you work in private equity or you work for some type of telecom fund or just any type of, you know, that finance world, that you're going to be around people that are a little more in like finance savvy, that's like, okay, well, this, we know this guy's with this family office and something along those lines, right? So if you're like some random guy from Tennessee, okay, it's going to be a little bit different. You're probably going to be going more friends and family, or you're going to have to travel to go find capital. But with that being said, like, a lot of you guys know that I've sat down with Derek Vickers a lot, and he talks about just going to country clubs and other wealthy areas. And, you know, if you have a good deal, like we're talking about, you can present it. Obviously, it's not as simple as, I got a great deal, give me $1 million. But, yeah, just to give a little backstory. So he does have a lot of finance background. If you guys are in the, not institutional, but, you know, the finance world or the institutional world, like this makes a little more sense than not.
Right.
But so how did you kind of make the connections, or did you have someone that was kind of like the bridge to connect you with a lot of different type of capital sources, or what did that kind of look like? And I know these are a lot of loaded questions because it's not simple answers.
Totally. No, that's a great question. So like 2-part answer to that. I think just to carry on my earlier point is to be open-minded about like where the capital could come from.
Yeah.
Because I mean, definitely a lot comes into play, like where you're located, what your network is. So I know plenty of people that have done very well with just friends and family.
Yeah.
And for them, it's largely social media, just telling people what they're doing so that people can follow along.
Yeah.
I think that's very important and bears just a quick comment that, you know, when you're doing business, it's important not to shove your business down other people's throat, but more so just openly say like, hey, here's what I'm doing, here's what I'm working on, here's some of my wins, here are some of my lessons, and let people follow along with you. And we'll talk about this later, but you know, when it comes to social media, like engagement is super important. Like it's less so about the number of views now as far as like the quality of views. So, you know, just for example, like I know someone who, you know, he runs a podcast, he's done it for like a few years, and like he'll just randomly get calls from people and saying like, hey, you know, do you have any deals? Like I have 500K ready to go. And that's like crazy. For us, like we haven't built it to that stage yet. Right now, we're working with just, you know, a few people, including one that's like super well connected. You know, he is like just has a career in finance. He knows a ton of people that are looking to put their money to work. We were really fortunate to connect with him and, you know, figure out the sort of like the capital stack, so to speak. So he's able to bring this deal to his connections and then bring the capital to the table.
So from your point of view, and that good point, I do want to get into the social media later on in the podcast. I'm trying to almost lay out a roadmap for someone like in the coaching program that Derek and I have. A lot of the questions we have is kind of, there's this gray area from, all right, they understand how they, like the type of deals they want to buy, have a loose idea of like where they can get capital from, and let's say they know how to find deals, they've wholesaled a few or something, or brokered a few, something like that, right? But then like actually coming up with a structure and then actually taking action on this, which is what you guys have successfully done so far, that's where a lot of them get stuck. So, all right, let's say you're in your position, you and Phil, you have a capital guy, at least you have an idea of, all right, here's who our investors are going to be for the actual money. What comes next now? So you guys reached out to me, we're going back and forth on offers, you get Shady Acres under contract. Now are you looking, like what's your next steps? Are you looking for your operations guy to kind of partner with so we have experience coming to the table, or are you kind of trying to get your capital guy committed to the deal because you're going to underwrite it and now present it to him? Like what's kind of your next steps in there? And then obviously now you've been talking with Judah and getting debt lined up. But what does that kind of look like? What's kind of the roadmap in there from how you guys played it?
Definitely.
I know there's infinite ways you can go about it, right?
For sure.
What's kind of the roadmap you guys took?
And I think that's a great question, Ramon, because it's not necessarily like a start and finish line. Well, okay, it is a start and finish line, but it's not linear. It's not like football. You run down the field and you're good. Like with syndicating, with putting together something like this, it's so many concurrent things at once. So, you know, for example, like we're trying to get commitments from our capital guy, you know, making sure that his investors like understand the deal and can get comfortable around it. At the same time, you know, we're coordinating the property itself, like we're figuring out the on-site, what is the condition of the property, do we feel comfortable do we know what we're walking into?
Yeah.
And also like getting the debt for it, answering like those guys, insurance as well, and then operations, it comes a bit later. Because that's more so like, hey, when you close, you're onboarding the property, you're letting the new people know, hey, like, or the existing people know that, hey, we're the new owners, like, things like that.
Yeah. Now, when you're presenting the deal to the capital guys, and you're coming up with the structure of like how they're going to get paid, and just to explain for a lot of you guys, so the reason why you could raise money or people are willing to put money into a commercial real estate deal is that you get them higher returns than, let's say, a typical S&P 500 or something like that. Like in commercial real estate, you could usually get around 15 to 20% internal rate of return over like a 5-year, sometimes 7-year, 10-year hold period. But that's really the reason why people invest in commercial real estate or hard assets instead of something as liquid as the stock market. It's because you can get the higher adjusted returns in exchange for illiquidity and higher risk, obviously. But when you're coming up with the structure now, so you're underwriting the deal, you got it under contract, or at least you're close to getting an offer accepted from me and you're talking with your capital guy. How do you come up with your base idea of, all right, here's the structure and terms we're going to be offering to our capital guy? Like what makes you decide, do we want to do a complicated waterfall and like it's going to be a 90-10 up to 15% IRR then goes to 70-30, or are you just doing a flat 80-20? Like how do you decide on that? Now what I've explained to people in our group, and Derek does a really good job of this, like if you could get them, whatever your structure is, if you could get them to around that 20% internal rate of return, doubling their money in 5 years, whatever that structure is, as long as it gets them to there and there's a reasonable expectation of like you're getting paid more so yourself as the sponsor on the back end, then it's like, okay, you're inclined to perform on the property because you make your profit by performing well, and then they can obviously get higher returns. But how do you hone in on that structure, and when are you coming up with that structure? Like you and Phil sit down, here's the deal, we underwrote it to this, here's the structure we're going to offer to this investor. What does that process look like, and how do you hone into your actual deal structure?
Excellent question. And the short answer is that it's largely we come up with a base sort of scenario. Hey, like this is what we make sense based on our initial underwrite, and then
so we think we'll get it to here in 5 years. Here's our rent growth.
And then as we sort of uncover things, we might change things, and maybe it's like, hey, we'll have to spend a lot more on, I don't know,
CapEx or something.
Exactly, and then that changes the risk profile and the return profile of the deal. So I think just communicating constantly with the capital guy, with our investors, like, hey, like here's where we're at, just letting you know. And I think you hit on a very important point that, so for commercial real estate, right, as with anything in general, like there's different risk profiles for everything in terms of how liquid something is, the return, the risk, etc. So for commercial real estate, it's less liquid, it's very hands-on. It's not like the stock, like the reason why commercial real estate run by these funds / syndicators do better than the S&P, they're like 15 or more percent return. Instead of like S&P is like between 7 and 11 for the past 100 years. So, I mean, the reason why is because you're having a team actively work on improving that business. And for commercial real estate, it's valued based on the business performance. So it's less so, the market fundamentals, like, Fed's doing this.
Because you can actually force the appreciation.
Exactly. So that is important. And as long as investors are like, okay, look, my goal is to double my money in 5 years. Whatever you get, I could care less, which is fair. And it just depends on the deal and the operations. So, for us, like, for example, we want to, at least in our initial deals, like align with the investor's favor as much as we can. We want to make it as much of a no-brainer, like, oh man, like we're exploiting these guys' labor and expertise for this. So we're giving a very generous split to the investors. We're working for like as little as possible to get into it, and then once we get more comfortable, we're like, okay, here's like our stabilized what we think is fair for the long run. Because keep in mind, when you're investing in these deals, it's illiquid, and you're partnering with these guys for 5-10 years. So, hence why, like, it's important to know the sponsors that you work with, like, the team that is actually enacting the business plan into the deal.
Now, this is a deeper question, and if you don't want to answer, you don't have to.
Sure.
All right, so you have the sponsor, the GP portion of the deal, right?
Yeah.
And you and Phil obviously are splitting that. Now, you have a capital guy, and then I know you're bringing in the operations partner for experience. How'd that negotiation look? What percentage of the GP are you giving away to those? Or can you give just a ballpark if you don't want to give the exact?
Yeah. Surprisingly, we haven't concretely defined that yet.
Okay.
I think it's more so like, we're lucky in the sense that we're working with people that truly, like, they want what's best for the investor, what's best for the deal. Like, we're working for our reputation as well.
Yeah.
Like, we want to do the job done right, and it's not like, some shark that's like 30% or I'm not even getting out of bed. Yeah. That kind of deal.
And we were talking about that when we negotiate like that. So.
There's some people like that, and good for them. They got in a position of their career that they can do that.
Yeah.
But for other people, I think, it's not that like we're less experienced, but it's just more so we have a collaborative nature, and that we're willing to get the job done. So, for now, like, we just assume like, hey, 4-way split for now.
Cool.
But then that, like, we'll take a closer look coming to closing and being like, okay, here's a huge list of the tasks that went into it. Like, who did what? Let's assign some percentages here.
So then it's like if they're taking on 30% more tasks, we're going to get more.
Exactly. And that's a common way to go about it. There's a few ways, right? Just to break it down. The easiest way is just like even split. There's 4 people involved, just 25 each. Versus another way, which is more fair, is just, like for us, like we want to be fair and upfront and transparent all the time. So we list out, hey, like for the acquisitions portion, like what goes into it, like coordinating vendors, doing on-site, who's putting up risk capital, who's being the guarantor on the loan.
Yeah.
These all weigh in, like who's doing ongoing management, who's doing like asset management, investor reporting, all these things. So we sort of go in and we're like, we're fair in that, like, we're not going to pretend like we're going to do something we're not.
Yeah.
At least that's the hope. So, we present people with that.
Yeah. So, like, an important takeaway that a lot of you guys can have from this is, like, you'll see, as long as you have your partners in place, and jump in if I'm saying this incorrectly, as long as you have your partners in place or an idea of who your core team is going to be, like, a lot of this gets figured out after you find a deal, you're making offers, you're getting under contract. So if you're someone that's looking to start buying deals, like, really you should be making offers and hunting deals first and have concrete properties offers accepted on, so that way you at least have some type of baseline to start going to work on it at. Like, hey, I have this deal, LOI signed, contract soon to be signed. I'm hoping to raise this much money. This is what the deal looks like. Like that, those are the first steps you should be taking. Like, a lot of guys get stuck. They're thinking like, oh, I don't have a capital guy. I don't have an operations guy. Like, I can't just be making offers. But the thing is, you find that through the deal sourcing process a lot of the time, which is why I really emphasize you guys need to learn how to find a mass amount of deals, because then that almost gives you a lot of shots on goal to learn how to put the whole team together and what you guys are doing, essentially.
Yeah, exactly. So, to sum it up, it's like you don't have to be great to start. You have to start to be great.
Yeah.
Right? It's just learning and iterating the process. It's not like, hey, here's a textbook, here's a formula, how you do it. There's like a lot of, I guess, like programs out there that, break it down into steps, which is helpful, but you need to do it and you need to go beyond it, which is what people don't plan for. People are like, okay, if I just follow this recipe, I'm going to like make a lasagna at the end. No, so there's a lot more. Yeah. There's like give and take. And so I think really the emphasis is not so much on like doing the thing, but more so like finding good people to do it with. It's easy to think in the present and be like, okay, let me just get this deal done. Like, maybe like, I don't care who I work with. But, in reality, like, if you're going to hold on to a property for a long time, you're going to answer to these investors for 5-10 years. So you have to make that decision carefully.
It's interesting too, like, so you're like a smart, financial, intelligent,
thank you,
speaking guy. I know some people from Ohio, and these guys are multi-millionaires that own tons of mobile home parks, self-storage, and everything. And he just has one or two guys from his like childhood neighborhood. Like I'm talking, these are like country dudes. And they just do a 50-50 split. He just buys properties. If you ask him about underwriting, 10-year IRR, he doesn't know anything about it. He just buys deals, and guys making tons of money. But it's funny how like you could be so complicated, or at least from your point of view, like you're a polished guy, and then to not discourage guys. Like there's especially in the mobile home park industry, which is crazy because it's big business. Like we're talking tens of millions of dollars, like $10 million deals. Like once you're getting north of that, like okay, now it's more institutional private equity. And it is sophisticated, but you got guys doing $5, $6, $7 million deals that are like still like your country guy who's got a friend back home that's got a lot of money, and they're buying deals left and right. So it's interesting, the mobile home park industry of all commercial real estate asset classes. It's very interesting how different so many different people in the industry are.
I will say this, that business is done with people, not numbers. So yes, I mean, it could be like a hindrance for a lot of people. They're like, look, I don't get how to underwrite it, blah, blah, blah. Like, I don't get how to forecast these things. But in reality, it's just like, hey, here's a piece of property. This is a business that you're running.
And it's going to make us money. So,
people forget that. And, you know, especially like when you come at it from like a large company perspective, like multi-billion dollars, I mean, sure, you have to be super, super organized. You have to present data or like present things in a way that other people understand. But fundamentally, and where most people are operating their business is in the smaller scale, right? I mean, nobody's operating like billion-dollar funds. Like, we're looking to purchase a few parks and like make something happen. So like you don't have to go crazy all over this. It's more so just what gets you comfortable, what gets others on board as well. How do you share that vision and how do you execute on it? You just keep it simple.
Now here's a question that I know some people would want to ask. I know the answer to this, but this is a good question for people not really in the real estate industry as much. If you have the money or you have the ability to save up the money to buy real estate on your own, why go raise money?
That's a great question. So there's no right or wrong, right? That's the beauty of life, of your career, etc. So if you want to go fast, go alone. If you want to go far, go together. So if you want to just house hack and get into a house yourself, like do everything yourself, you could. And you know, you could buy one property every single year. You could do that, or you could.
Some people make it money. Some people make it.
Oh man, like just investing in your own like house hacks. Like I have a property up in Massachusetts. It's terrible, man. The cash flows don't work out. Like and like one unforeseen circumstance.
There goes all the cash flow for 3 years.
So I mean, this is a side story, but I was running the numbers, and like you know, the money that I invested in other syndicators, like completely passive, has been yielding better returns than like something that I put in my sweat equity into. I like tried really hard to make it work. I'm managing it. I'm spending so much time for like this teeny tiny little cash flow every month. So I'm like, is it even worth it? So in that sense, it's like, okay, you're offering a good product to the market. You're helping your investors, like your friends and family, you're helping them build wealth by putting this together. So for me, you know, why I was doing this intrinsically, I'm like, okay, I've had a lot of different diverse experiences in my career, in real estate in general. I've gotten a good knowledge and like a good sort of road ahead of me, and I want to share my knowledge with people. Now, obviously, like, you know, if we all win and make money together, that's amazing. So that's the opportunity that I give them.
One thing that I do want to add too for newer guys, and why you would want to raise money versus just buy stuff on your own or not bring in outside capital. When you think of deal sizes and unit counts, right? Like if you're buying smaller deals on your own, let's say a single unit building, and you're doing, let's say a single unit building was valued the same as a commercial real estate deal. Debt service coverage base, income base, right? When you're doing a $10 increase on one unit versus a $10 increase on 100 units, that's a difference of a $10 NOI bump per month versus a $1,000 NOI bump per month. Now, when you're looking at that on a cap rate basis, let's say everything's each increase in NOI is sold at a 6 or 7% cap rate. That's essentially a 12x multiplier per each dollar of NOI that you increase. So if you're raising money and doing larger deals, the way GP or syndication structures usually work is you as the operator, you get paid a higher portion of the back end success. You have a greater ability to increase the value of the property based on the amount of units, which is why Cardone always says buy more units, forget about the NOI and cap rate. Now, that's obviously a hyperbole. It doesn't actually mean just ignore all those other factors. But a lot of times when, like, the reason why people raise money who are good at operating deals is everyone makes more money with more units and more size and more scale, which is why, like, there's, I don't want to name drop groups, but there's groups out there that I broker deals with, and then I have another park nearby. And at the time, they were, let's say, a small to mid-sized group. Let's say Open Door Capital. Open Door Capital would look at a 70-unit deal. Like, I sold them a 89-unit deal in Indiana.
Yeah.
They wouldn't look at that same deal now because they have so much capital, so many people involved. Like, they need to buy 100-unit plus now. They wouldn't even look at 80 units, even if it makes sense on paper. So, like, even if you guys have the money and experience, you want to learn how to raise money like Leo's doing, because that is like a skill that gets you to the next level, that just buying one deal here, two deals here on your own or with one guy, it's not an efficient way to scale up as fast and build wealth as fast, because you're limited on the amount of units and the amount of scale that you could usually get.
Totally. And to add to that, Armand, that's very well said, is that when you're looking at a single unit, it's most likely, one that you can buy yourself is most likely residential. It's like 1 to 4 units, versus if you raise money, you can buy more. Yeah. So back to the earlier point, residential is valued on comps. So if you raise your rents by $100, doesn't matter. Your neighbor's still selling for the same price. Great, good for you. Versus commercial, like, you can actually increase the value. And the bigger the property, the lower the cap rate, and the better the valuation. Yeah. So, like, the more leverage that you have with your sort of net operating income. So just think of it like, the more profitable that you're able to get a larger property, then your returns are more leveraged. Yeah. So that's the benefit of that. Yeah.
You know, it's an interesting thing that happens now, and it almost, like, growing up, you know, you listen to Bigger Pockets, and even Brandon Turner himself says this.
Yeah.
But, like, back when he was still doing residential, before he was big Brandon Turner, Mr. Big Fund and all that, like, and he was doing the house hacking Mr. Burr method. It's funny how now the way real estate has gone, the better a deal is, almost across the board, the less it cash flows. It's kind of interesting that, like, all of the highest potential growth equity plays where you get these crazy increases over 2, 3, 4 years, those types of deals are in markets where cash flow does not exist anymore. So, like, the idea of, like, cash flow and safe investing in real estate and it being kind of like a safe haven for your money, that's kind of gone away because we're such, like, a leveraged, debt-based equity appreciation society, so to speak. So.
Especially around bigger cities, Yeah,
like in Florida, people just what cap rate? What's that? Like,
right, exactly. And you know, I will say, like, you know, for like house hackers and a lot of things like that, it used to make a lot more financial sense. I mean, not financial advice, but, like, it used to make a lot more sense numbers wise when you're looking at these house hacking things. Like, from 2011 until, like, now, pretty much, it's been a crazy bull run. It just makes complete sense. But now you have to be very careful. You're like, okay, what is the housing market going to do next? It already did that. And, you know, if you study sort of human behavior, like, human behavior is all the same.
Going like this for 10 years.
It's going to come down, like, no matter what. You look at all the different charts for different assets, different investments, and it does the same thing. So you're thinking, okay, the housing market just did this. What's going to happen next? How do I protect myself? And, like, as an individual investor, like, I know there's a lot of people out there that they're looking at that 1 to 4 family. They're like, finally saved up enough money. I want to do it. Rates are 7%. Like, you know, screw it. I'm just going to go for it, get a property under my belt. And then they get screwed. You know, like, something unforeseen happens, and, like, they're cash flow negative. They're having to come out of savings. They're paying the tenant to live in that house. So point being said is that, I mean, the market is not as it used to be for the past 10 plus years. So, like, we have to be more careful. and look at things differently.
Yeah. Yeah, it's interesting on the residential market too. How, like, since the values aren't based off of actual income and things like that, like there's a lot more variance in where the values could go based on other outside market conditions versus at least commercial real estate. Yeah, the interest rates can always screw you, but within reason, as long as you're still driving up income and you're in like a safe market, aka like Danbury, let's do Shady Acres, like. There is no cheaper living than this mobile home park in Danbury. Yeah. And this is a very nice mobile home park. Like this looks like a neighborhood. So like there's always going to be someone that's willing to pay that rent.
Yeah.
Meanwhile, like residential, like you could be increasing the value of the property, and the market obviously tanks like it did in 2008 to 11, and next thing you know, you lose 50% of value in the house for no reason at all. Right. Which is it's something crazy that I guess a lot of people don't kind of take into effect.
Right. People forget.
Yeah.
The time has been nice for too long.
Yeah.
People forget.
Yeah. So what's this deal that in North Carolina you guys are looking at?
Yeah, so it's a little under 80 units. It's in a very tertiary market. You know, like it's in an opportunity zone for one. So that gives an interesting twist to things because, I mean, so for just to take it a step back, I mean, opportunity zones is a great way to sort of get your capital gains forgiven. Yeah. So, you know, if you invest into an opportunity zone for more than 10 years, your capital gains on that property is forgiven as long as it's qualified. Another point that we could talk about potentially is just, you know, the government, the tax code, whatever they're incentivizing. Yeah. But so anyways, 70-something mobile home park lot. It's about a third full right now. It's very mismanaged. You know, the sellers, like they're essentially it was a JV done by this group many years ago. One of the partners was a property manager in addition to being an owner. Okay. Totally didn't look after the park, was embezzling funds, like doing all that crazy stuff. So the other owners found out, sued, got the property back, and now they're just tired. Yeah. And it's crazy to see, you know, what happens if you let a business go. Yeah. Which is what they did. So like for almost 20 years, they barely did any work to the park. If you look at the Google Maps historical images, you could see, you know, back in the early 2000s, completely full. Yeah. Now it's only a third. Oh, wow. And like, you know, we did our on-site recently, and you literally see trees growing through people's porches that they've abandoned. Yeah. And it's like simple things like that, just keeping an eye on something, just like trimming these things. Yeah. Don't let it get that far. So for us, this is a turnaround project. You know, we're confident in it despite it being a tertiary market, that the demand is still there. We ran test ads, you know, it makes sense for us.
How tertiary? Can you give me like a general idea?
Yeah. I think it's like a few thousand as far as like a population,
for like
super
the actual
small.
Town. What general area of North Carolina is it?
It's close to the Norfolk, Virginia area, so like close to the
so kind of like Roanoke-ish.
Yeah,
like east
Okay. Exactly. Yeah. So for that market, it's kind of quiet. On paper, it causes a lot of people to pause. Yeah. And that's another thing that when you're looking at an investment, it's one thing to look at the numbers, it's another thing to look at the deal itself. Yeah. So this is one of those that when we looked into the deal and like we went on site, we were like, wow, we really have a gem in our hands. Yeah. As opposed to on paper, you're like, 30% occupancy, tertiary town.
This is a mess, yeah. And when you see it, you're like, oh, we could provide value.
Yeah, exactly.
You know what's interesting? Grant talks about that, where he's like, I don't even look at the underwriting. I know he always says these hyperboles, but he's like, I don't even look at the underwriting. I need to walk the deal and feel it. But it's like, well, I feel like people forget about in real estate. Mm-hmm. Like, when I'm looking at like certain mobile home parks, right? Mm-hmm. Like, and I'm running into this issue in this North Dakota deal that I have listed. Yeah. In that, all right, everyone's scared of the market and whatever with the financials, but it's really like, can you look at a property and increase the value of it to the marketplace? If you could do that, it's going to make money. I mean, if you're buying, right? Obviously, if you're overpaying, you get screwed. But like in this case, like, all right, like all these things on paper look bad, but like you're saying, when you're there, you're like, oh, there's very clear turnarounds we can do here and instantly increase the value of the property. Exactly. That's something I always thought myself is interesting on like deals, because I try and fly out and see a lot of the parks that I broker
Right.
and shop around. And
Yeah.
there's been some, like there was one in Cassville, Missouri that was like a seller finance deal. And when I drove it, I was like, dude, everyone is like really missing out on this fucking property.
Yeah.
And like that, it's interesting that you kind of have a
Right.
similar takeaway. Like
Yeah.
if there's real legible, like this is what something we can improve to the property.
Exactly.
Yeah.
And I think it goes back to the point that a lot of people, like, they learn from the books.
Yeah.
I mean, everyone learns from the book. It's just a shortcut to learning, which makes sense. But, you learn from looking at the deal from a number standpoint first. And you try to make things work in that sense.
Yeah.
Versus, like, going into the property, that's more like, those guys out in Ohio, they're, like, actually living real estate.
Yeah,
They're
yeah.
not living the numbers.
Yeah, they don't live on the spreadsheets.
Yeah,
That's the perfect
exactly.
example. He's the type of guy who looks at it, he's
Yeah.
like, I can make money with this.
Yeah, exactly. So that's real estate, man. People they try to make things complicated and stuff, but like at the end of the day, it's just you're providing a service to the economy. It's a business.
Yeah.
That's it.
So what other specifics with that? Are you under contract on that deal?
Yep,
Or-
under
okay.
contract, closing soon.
Okay, all right. Rock
yeah,
on,
yeah,
let's
yeah.
go, baby.
Thank you, man.
Hell yeah.
Appreciate it.
Was that like a smoother kind of, because I'm assuming you're buying it like super cheap,
Yeah.
cents on the dollar. Since
Yeah,
you say
yeah,
blow
yeah,
off and
yeah.
things like
Yep,
that, so
yep.
it's a little more easier
Distress
to make
it.
sense of it.
Exactly,
Yeah.
exactly. So yeah, I mean, for that one, hoping to close in the next couple of months. Things are checking out so far. There's obviously so like I said, with the numbers versus the property thing. On paper, it's like, hey, why is it so empty? And it being a small town, are you going to be able to infill? That's the questions that a lot of people bump into. So like lenders, people like insurance, they're like, we don't really like this. So in that case, it's important for you to be creative and figure out like, how do you move the ball forward? How do you still get a solution? So, maybe you approach a local lender or someone more familiar with that market to get them comfortable around it. Or, just buy a cash or like just make it happen somehow.
On that deal, did you guys, same capital guy?
Yeah, yep,
Okay.
yep.
And then, did you bring in outside guy for operations?
Yes.
Okay.
Yep.
Not the same as...
No. So we try to partner with people that are like familiar with the market.
Yeah.
So yeah.
So someone North Carolina based?
Yeah.
Who was it? Let me ask you.
Dominic.
Oh, okay.
Yeah.
Cool.
Yeah.
Oh, okay.
I mean, he's got like,
Cool. He's got
he's
got good use.
plenty of operational experience. He's done infill himself. Like he's been able to be super resourceful. Like putting in like used homes, like finding these things.
Yeah.
So
he was telling me that
Yeah.
his like majority of his portfolio he bought at like a disgusting low price per pad like 8 or 9 years ago.
Yep.
Like
Totally.
5,000 a pad or something like that. Crazy.
Yeah.
That's crazy how like in a what's so interesting about the mobile home parks and why this kind of went away by now, but how it was so neglected. And then people came to realization about it. And like even the guy who owns the brokerage I work for, like he bought his parks like before, like no one ever thought Florida 100K a pad. What are you talking about? And like back then they were like 20K a pad's way too much money.
Right.
And it's crazy how like if people got it before a lot of the institutional money came into it, it was they just rode their way to wealth. Just
and that's another thing, when it comes to real estate, right? Like why you pick a certain asset class, like there's different sort of profiles. If you look at, for example, multifamily apartments, they're the most, I don't have numbers to back this up, but it feels like they're the most saturated asset class out there. Everyone learning how to get into commercial real estate, they go into the multifamily space, and everyone just gets it because it's like, oh, that apartment building, I get it.
Yeah.
Compared to taking that sort of risk into the unknown, you're like, mobile home parks, is it like trailer parks? Trailer park boys, like, what the heck is this? There's like that sort of value discovery.
Yeah.
So, as an industry, you have to like take a look at how much value discovery there is.
Yeah.
For example, like something less well known, like wineries, like marinas, like people don't really know like what the valuation is. The market hasn't caught on.
Yeah.
Right now, they cash flow like crazy. They print money.
Yeah.
So it's just a matter of like what is known, what is not, and then each one has its own challenges, right?
Yeah.
Because mobile home parks super well known now. Financing is much easier to come by than it was 10 years ago, 20 years ago.
Yeah.
Before, I mean, Frank Rolfe, right? he gets all his deals like seller finance because like the banks are not going to touch it, right? So it's just like you have to ask yourself like what sort of ballpark or like what game you want to play.
Yeah.
So yeah.
This North Carolina one too. How'd you try? Are you guys still lining up financing, and how'd you go about that? Did you get a mortgage broker or?
Yeah. So for that one, like the banks didn't want to touch because it didn't make sense on paper. Yeah. So right now we're actually sort of circling and like finalizing some like debt potentially like just private investors. Like we're giving them like a great return for their money. We're like, hey, here's this park. We're confident we could turn it around.
Yeah.
You're in first position. There's no bank.
Yeah.
You don't need to worry.
Yeah,
You'll get your money no matter what.
Yeah.
So something like that.
That's cool. What kind of interest rate? Are you like?
12.
12. Yeah. I figure it'd be low.
Yeah. So it just makes sense for them because it's like, where else are you gonna get 12% for like 5-10 years?
Totally. Yeah.
So make it worth their while, and then money talks.
And how'd you get introduced to them? Through Dominic or?
No, through the investors, just networking.
Cool.
Honestly.
Yeah, because I know finding private money is.
Yeah.
A lot of deals get done in mobile home parks with private money, especially for like the heavy turnaround.
Yeah, a lot of the initial sort of interest came from LinkedIn. I will say that.
Interesting.
LinkedIn, it's I guess it's becoming somewhat better known now.
Yeah.
It made a transition from like like a digital resume site to now like
people are making thoughtful posts. It's just and this is a good segue into social media.
Yeah.
You know what I don't like about LinkedIn? It's like, all right, the commercial real estate LinkedIn, maybe I'm not as sophisticated of a guy, but I hate that everyone speaks in such like fairy tale syndicator language instead of just saying what's going on. Like, let's give an example. Like, let's say the phrase, we're going to see rent compression or whatever. It's like, why can't you just say the rents are going to go down? Like, why do we have to use these fancy terms and stuff? Yeah. Like, and I know that commercial real estate guys love to talk in like the super fancy terminology, but sometimes it's kind of, can you just be like, listen, I don't think we're going to sell it for the same cap rate. Like, you don't have to be like, we're assuming a lower dispo cap rate in year 5 with our assumptions. It's like, just say like, I don't think we're going to sell it for the same price 5 years ago. Right. Like, why do we got to say like these fancy jargon terms? But LinkedIn loves like the long, super fancy posts, and then everyone's commenting, great insight, you know, we're seeing this and this. Man. And it's like, Jesus Christ. I hear you completely. But I hear you though. It's like, it shows the intelligence of what you're doing and everything. But LinkedIn's tricky with that.
For sure. Man, it's a give and take with these because it's like, I mean, sure, commercial real estate, I mean, it's not as bad as like finance and private equity, right? Like with their jargon and their terms and stuff. And like, I mean, sure, there's like some need for it, but then also like, then you're pigeonholing yourself into like just those people that you get. Which, it's a trade-off. And, this is my hot take, is that a lot of commercial real estate, a lot of finance is just like, especially if they're like at a higher sort of organization, they're just trying to prove their worth to the world by throwing out like large jargon and like making themselves seem impressive. But in reality, like, the power comes from how you could break down a message simply. I mean, look, Steve Jobs, right? Like, he didn't be like, hey, look, this iPod is like, 14 gigabytes of RAM or like whatever, like da-da-da. He's like, hey, look, this little thing can fit in your pocket and store 1,000 songs. That's it. Like, everyone gets it. Everyone gets it. So, like, you have to think of like, okay, what's your audience? I mean, there's no right or wrong. It's more so like, who is your audience? If you're trying to raise money from like, regular people or just like more people, you want to demonstrate that you totally internalize everything and you can explain simply to them. Compared to like throwing out cap rate compression.
Like, I was looking, Brandon Turner does a good job on LinkedIn where he balances. He still talks the intelligence enough to where it's like all like the finance dudes are all on board, but like simple layman's terms too. Like, Brandon Turner does a good job with it. Nice. I need to scope through your LinkedIn. Do you post a lot on LinkedIn? Andy loves LinkedIn too. Andy's deep in the
I was talking to him about it.
Andy's always commenting on the super bougie ones.
That's funny. It is helpful and it is changing. So like for me, I do post on it, and I take the stance that like I want to be the change I want to see in the world.
Yeah.
So like I'm not a very like numbers, all that kind of guy.
Yeah.
Because like sure, I get it when I'm speaking to like an institution, like they'll have their jargon, completely fine. But when I'm on there, I want to reach more people. I want to just tell people my story. So like I break it down, I keep it simple, and I specifically don't sell on my posts. There's a lot of people that just like, hey, you know, I went through this transformation and now I'm launching this master class. Blah, blah, blah. And like 200 something likes. Great.
Download the free guide.
That's right. I mean, maybe down the line, but you know, for now, I just want to play with it. I want to, you know, experiment with putting myself out there because that's not natural for a lot of people, right? And you have to like work up to figure out what works.
Yeah. Yeah. So Leo and I really bond on our thoughts on social media and how we think it's going to drive a lot of the just sales of everything is going to eventually transition to online just because it's purely scalable. For example, we could have this conversation. We could have this conversation essentially as a meeting with 3 other people that sit with us, right? Or we could broadcast this. And let's say on this video, we're probably going to get 120 to 130 views. Yeah, that's low, but that's 120 to 130 people that we're speaking to, all with 1 unit of output. So what's your thoughts on social media? How do you plan to incorporate that? Because it seems you're going down the path of creating a very strong private equity or just a very strong syndication type thing, and maybe grow up to a private equity fund or something like that. But how do you plan to incorporate social media? Do you want to use it on the deal sourcing side, which is similar to what I do now, or are you eventually looking to transition to raising retail money with social media? Then what's kind of your plan driving into that?
Yeah, sure. Great question. So definitely my plan is to just put myself out there first. Like step one is to make sure that you're known. So, you know, Alex Hormozy, he has a great quote that says like, hey, the longer you could post on social media without selling, the higher you can go. Like the longer your runway
higher
is.
Trust
yeah, exactly. So I'm not so much concerned about that for now. Like I started posting earlier this year, and I've gotten like a ton of requests, like a ton of people reaching out to me, and like I've just had the most interesting conversations ever. Connecting with people from deal sourcing to lending to investors to anything. So I think for now, keeping an open mind, just like putting myself out there, like not like having any products. But I will say, as far as social media, where I think it's going, I think this is a great development that more people are getting on social media because society is democratizing attention. You know, in the past, like, I don't know, like 10, 20 or so years, like it's all companies like pushing down stuff on you. Versus now, it's like you could follow people that you connect with, that you like, that you trust. And to sort of bring the point home, like I cannot remember the last time I bought something based on a salesperson selling me something. Like, hey Leo, just following up with you, what'd you think? Like, never happened, but I bought so much from social media, just like following people I like and stuff.
So that was my thought with when I first came up with my deal sourcing process, and we talked about this before off camera, but my biggest thing was I've never bought anything from anyone who talks to me on the phone. My entire life, it's never happened, and I'm like, why is that my main way of selling? And I was like, this is a flawed process. Like 99% of the communication I do every single day does not happen when I'm speaking to someone on the phone. Yet the only way I get a hold of people is by speaking to them on the phone. That to me was like, I'm just doing something wrong. Like, this has to be fundamentally wrong. And like, I know commercial real estate's an older industry, right?
For sure.
So the phone thing still drives, and obviously big multi-million-dollar decisions, you're going to have a meeting. But like the ability to get more of those meetings really happens from, we're talking about social media, and not social media. All right, guys, you post like a lot of old people mix this up. When we say social media, we're not saying some stupid like, oh, we just post something on Instagram. Like we're talking about like curated posts with a proper funnel online that actually routes them to some type of call to action or some type of offer or some type of lead magnet or some type of actual quantifiable sales process through social media. So when we say social media, we're talking about an actual like sales process that's basically on the internet, not just like, oh, let's just make a Facebook post and hope for the best. Which is crazy how you could do that and like make sales, which is something that's wild. But so you're looking to basically just kind of build the brand image. I'm assuming once you guys get one of these deals across the closing table, you're really going to ramp up posts about here's how we did it and things like that, I assume.
Yeah.
Is that like having a real track record behind it?
Definitely.
Helps.
Yep. And I think just to deconstruct what you just said, Armand, so two things came to mind. First thing is the importance of being genuine.
Yeah.
And not just posting to post.
Yeah.
This is like the evolution of social media. It used to go from like, hey guys, like market update, like New York, like, apartment condo, whatever, like sales is like this, versus like now people seem to value more and give more attention to people that are more genuine. For us, having this genuine conversation will be much more impactful than someone like reading off a script. Hey, here's like market update, da da da. So I think being better and being more genuine in what you post is like a really, really good value. And that's what I'm practicing right now. How to be more genuine.
I think podcasts, that's why podcasts have blown up a lot. It's because it's hard to get a 2-minute genuine.
Yeah.
Like, let's say I sat in front of a camera and I want to talk to it for 30 seconds and do a 30-second clip. It's hard to get a natural 30-second clip sitting down and intentionally talking. But if we do a 2-hour-long podcast and then pull out 30-second snippets from it, then that's like true, genuine things. That's why I think podcasts are blowing up, which kind of coincides with what you're saying about the genuineness.
Yeah. And then the second point is having a funnel, right? So, for like business owners, for like people out there that, you have to think in terms of like ROI, right?
Yeah.
When you're talking like to your manager at a company, like how do they measure your progress? It's like usually through KPIs, like how many cold calls did you make? Like that's like easily measurable, and that's why like cold calls and like these cold emails, like they're so prevalent right now. But it's hard to be like, okay, like how many podcasts did you put out? Like, oh, it got 100 views. Oh, okay, why didn't it get 1,000? But oh wait, the 1,000 or the 100 views were like much better because like, hey, you connected with a seller that wants to list with you. He saw all your other podcasts and he's like, man, Armand is legit. I want to do business with him.
Yeah.
How do you measure that, right?
Yeah.
So having that sort of trust in the process that like social media will help you if you put out the right content, and also building the infrastructure to funnel that attention, right? You have something that gets someone's attention, and then you're constantly trading value and bringing them down the ladder. And they could take action if they want to. They could join your coaching. They could list a property with you or anything like that.
Have you put in a lot of thought or learned a lot about like Facebook pixels and how that works?
Once upon a time,
that's like my next wave, because I know I get a lot of people through my own funnels, and I know this isn't really that good for the viewership right now, but just genuine conversation between us. Like right now I get a lot of people to my website, but I'm not able to retarget them. So like I'm now learning about like, okay, the pixel on the website, now you can start to target them on the social media platforms. Have you like any experience with that? Like that's something
for sure
I'm slowly getting into now.
I used to be much more into like social media marketing back in my sort of broker days, or like more so on the residential side really, because it relies on like advertising instead of like commercial. It's like more so like networking, in my opinion. Back then it was like the pixel sort of tracks like who comes to you, and then you could retarget them. And I think that is something very helpful to learn if you want to be able to drive more business to your company, because to anybody, seeing an ad or something for the first time, it's not going to convert them. 99% chance it
has
won't.
To be like
you have to see it so many times.
Ads,
Man, I can't tell you how many ads, like when I first saw it, I'm like, I hate this. And like 4th time seeing it, I'm like, dude, F this guy. I hate him. 17th time, okay, fine.
It's like, all right, I'll take a look. The next year you clicked on it and you kind of look.
He's actually legit.
No, 100%. There's a lot of guys that I thought like I'd never watch this guy, and then I'm a fan now. I'm like, wow.
It just takes some time. Alex Hormozy was one of them.
Really?
I will say, because like he's just like, I don't know, the image that he shows me is that like, hey, look, he dresses up in this like weird outfit with his button down and like his sleeveless shirt. It's like he doesn't even care.
But when did you find him? So I was following Hormozy when he had 7,000 on YouTube.
Wow.
Yeah, he was still doing the big mustache video and
Yeah.
Facebook front, like your just camera.
I don't remember, honestly. Like, I just see his stuff in passing. It's like, what's up with his nose tape?
Yeah.
Who's this guy? And like, I couldn't stand him for the longest time. And then I started listening to him. I saw his videos and I'm like, dude, this is so clickbaity.
Yeah.
But then looking into it, I'm like, okay, fine. I see the value into it.
Yeah.
And then I changed my mind because and that's just how you're supposed to go through it with social media. It's just super long. It's like starting a business, you know, like your brand is your business, and like to get it off the ground, you need to do a lot. It's not like, hey, you know, follow these 5 simple steps and like you'll get your lasagna or something. Yeah.
You know, it's an interesting thing with the social media, and this plays into like raising money or just anything. One thing that I learned from transitioning to internet-based deal sourcing versus the cold calling base is you actually can't do both. And let me explain what I mean by that.
Sure.
So an interesting thing has been, I do not call someone to give them a deal. Typically. Now, there's a few guys, like obviously you guys with the couple other Connecticut stuff and like specific people, but someone's like, I've been reached out by wholesalers asking if I could put their deal in front of other buyers, and it's like I can't even do that because the way my system works, it needs to go like within my system that goes onto my internet blast and everything. And now with raising money, it's like, all right, you guys are going the networking approach. So like you have a guy that raises money from another guy, but if you guys transition to like retail money through social media, like that sales process is so drastically different than the other. It's almost like you have to do one or the other. Like you either have to be the guy that's doing attention online, funnels to webinars to where you present your deal and raise money that way, or you have your few capital guys that you just buy deals with. Like, are you looking to ever make that transition to where it's like, okay, this is what our focus is. We are raising money this way and not that way. Or you're still just so early on that you're really, let me just build some type of internet presence, develop who I am as a brand online, and then eventually see how to transition it.
That's a phenomenal question, man. So for me right now, it's primarily back-end networking with some presence. Now, I mean, I've been posting on social media, like as far as like a business goes for, I don't know, like 5-6+ years, just like experimented with different things. But you have to know that like every time you change sort of your focus, like you would need a different approach to it. You know, like as a real estate broker trying to sell more houses, it's different than like a syndicator trying to raise more funds. So these things will take time. But I will say, like, for now, just looking to get better at the platform for my own sake, because I recognize the importance of social media, of digital marketing. Because you're essentially learning how to sell without selling. And you're being able to leverage, back to our earlier conversation about commercial real estate, you can leverage attention, and like where attention goes, money flows. So it's just putting the upfront investments into the right vehicles. So for me, real estate, social media. Two main ones.
The all right, switching it up now. Because I know I'm kind of in rapid fire questions, but I like getting your inside stuff. Do you think buying these deals is enough money?
No.
No.
I mean,
what's the deal size of the North Carolina one? Like rough, just
$1 million.
Okay, so it's small.
Yeah. So
how many total pads?
78.
Oh, you guys are talking. Yeah, you're rocking.
Yeah, right?
Oh, yeah.
It's nice.
Dude, what, did everyone just pass on that deal? That sounds, I mean, oh my God.
We actually walked it. And we're like, wow, we have a gem.
Even did Nara see it first or anything?
I don't know.
That seems like something you buy. Because, like, so I sold one in Enfield to them.
Okay.
This is a way back. This is like 3.5 years ago. Kind of middle of nowhere, small town and everything, but it was less than $7K per pad. So they were like, we can't not make money with this. And they don't have it to anywhere near 100% occupancy. It's still somewhat underperforming, and they've made an insane return on it just because their basis was so low. So like, I'm surprised that you guys are able to, because North Carolina is a tough market to get in there, especially being like out of state guys.
Right. And it's like super random. I mean, like when we went on site, it's like, whoa, like all these pads are like, it's like clean and huge space for everyone. Like the trees are all well kept, and we're like, oh my god, why do people pass on this?
Yeah.
But anyways,
the money, it's like, because when you're raising money and splitting up the GP and stuff, and we were talking about this a little bit when we were out at dinner, like, man, it's just like, it's not a lot of money. Like, where I get stuck is like myself.
Yeah.
And curious your thoughts. I'm like, all right, I view myself as smart enough to where I should be able to have a lot of liquidity while also building wealth and making money.
Right.
It seems like the decision to buy real estate versus, let's say, broker or wholesale is like, it's one or the other. Now, I do know, like, where I think I'm going to go soon is just, all right, as I'm brokering so many deals on some of these off-market ones, I'll just take a piece of the equity for like whatever. But like the decision to actually buy and try and be on the operations side, I don't see how it's that lucrative. But it seems like the smartest guys do that. So that's where I'm like, I don't understand. Like, I don't know.
So,
It seems like there's not like, all right, when you could buy deals way below what they're worth for like the last 6, 7, 8 years, that's one thing. But now we're not really in that zone anymore. Where I'm like, is it that worth being on the buy side?
Yeah. So, simple answer to that is scale of operations. Yeah. So, for us, I mean, any individual deal, like, it just doesn't make sense to get it. I mean, like, it's like maybe like a few $1,000 like a year that you would get, and like no one in their right mind would do it. But for us, like, we see the bigger picture. We want to get good at operating commercial real estate, operating mobile home parks, commercial real estate, or just businesses in general, because
then you could go to the mass.
Exactly. So like once you have that skill honed in, and on the back end you're like making deposits into your social media, into your leveraging the attention, then you match the capital or / the attention with the deals, then you could scale up much more, you could bring people in. So that's the way that I view it, because like as an individual I'm more organized, I like my systems, so I'm thinking like, how do I make the most replicable and most effective system? Then I could teach it to others. And then delegate myself out. So that's the end goal. It's not something that's like quick. I mean, for brokering, it's great. I mean, like closing comes, like get that fat check, you're good. Right, on to the next one. But yeah, I mean, I think it's not impossible to do both, if you wanted to like just dabble and like just learn and like view it as a paid learning experience. That's not, because it depends. Like in life, if you talk to a lot of the older people, like, and say like, hey, how did you get here? Like, they will not know that, hey, like I designed my life at 22, like here I am at 55 doing exactly what I planned. So I think part of life is just figuring out what works, experimenting, like trying new things out. Hey, should I switch lanes? Like just figuring things out that way, and being curious enough to experience life, and have fun with it.
Have you talked with Luke DeGrassi and Nick as part of Pioneer Communities?
I don't think so.
They're two young guys too that they started just like you. They were two finance guys out of New York, and then they started buying parks. They're like, they've probably been in it like 5-ish years.
Nice.
But they're super intelligent.
Yeah.
You guys would totally get along.
Nice.
That's cool. Any last things you want to go over for the podcast, or any topics you want to cover before we cut it?
I think this all comes down to, to like the people watching, it's just like, hey, where are you putting your investments? And like you ideally, like if you have a long life ahead of you, then you invest differently than someone who's like halfway through life. For me, for a lot of the younger guys out there, you're choosing something like with legs, like real estate. You can develop out your portfolio, social media, you learn how to like get attention, how to deliver value, how to exchange it in a good way. So just be open-minded, and also like you need that tenacity inside to like do what you need to do to get things done. I think that's just in a nutshell how you can succeed in this market.
All right, last bit of advice for younger viewers. Should someone even start in residential, or just say F it, skip the small shit, let's go into commercial? Because you did the residential thing.
Okay. That's a great question. I know a lot of people are inclined to say that just go straight into commercial, but there are like great lessons to be had from residential.
Yeah.
What I learned is how to communicate with a lot of different people from like a non-business standpoint.
Yeah.
Like it or not, a lot of people still make decisions. Most people still make decisions on decisions.
Yeah.
And like commercial, it's all numbers, but it's numbers wrapped in emotions.
Yeah.
So like understanding that dynamic, how to like set expectations right, how to communicate properly. Also, residential is a lot more social media based. So like I got over my initial sort of like camera fear and like all of that stuff. Like I learned all of that like from residential, just how to present yourself, optics, these things, and like it's actually taught me a lot.
Yeah.
So I wouldn't say that it's like bad to be in residential. I mean, just try it out.
And you were doing Boston real estate?
Yeah. Up in Massachusetts.
Did you ever do any here in New York?
No. So my license is up there. I've been debating if I should get it here, but for now, no plans.
Yeah, no, curious. I always wonder what the because broken mobile home parks. I mean, it's great money,
Right.
great money. Like I just had a closing last week, so
Nice.
I'm sitting
Congrats.
heavy now, which
Congrats,
is cool. It was Ferd's deal.
Oh, okay.
Yeah, in Kansas
Nice.
City.
Oh, okay.
Yeah,
Okay. Nice.
so,
nice.
No, that was a good one.
Mm-hmm.
But what I always found interesting, I'm curious the lifestyle of brokering, what it's like doing like $1 million residential in New York. I wonder if it's like a lot of fun.
Right.
Because commercial's kind of boring. I'll be honest, guys. Like finding deals and everything, it's exciting for the negotiations and like the deal. But then once it's under contract, it's kind of boring. Like honestly, like the ball's in your guys' court.
Right.
I'm just like, hey, let me know if you need
it. Right.
And then like I don't even meet. Like, I've never even seen the park that I sold.
Right.
For
Yeah.
Ferd and I, the only reason why we ever met in person was just because of MHI. Like we would have never actually met.
Right.
Even though we knew of each other. So like it's interesting that in commercial you almost don't even feel the real estate and see it from the brokerage side. I choose to fly out and see almost every deal. Yeah. But that's just because I actually want to be engulfed in the real estate and eventually buy operate.
Right.
But I'm curious, like the residential. Did you have fun doing it? Like, what were you focusing on? Was it like, were you doing like really big shit or small shit?
I honestly like everything in between. So like strangely, I went into real estate like specifically as a broker, like to learn.
Yeah.
So I didn't shy away from anything. I worked from anything from like little like Section 8 rentals to like multi-million-dollar mansions, like literally everything. Yeah. And to me, I view it as a learning experience, not so much like how do I build a sustainable business? How do I focus on one town? How do I focus on one asset class? Not really. I wanted to learn to become a well-rounded person. Yeah. But also like residential is a lot more emotions-based, like I said, which is honestly important for something like social media. You have to figure out like how to get people's attention, how to get them to feel a certain way, like to like you, to take action.
Yeah, because it's not like it's not sharp businessman looking at numbers.
Right.
Here's the numbers I need. All right, I'm in.
Exactly, because chances are, like just take New York for an example. Like you see those TV shows, like they have these large extravagant parties, and it's like, what's differentiating this one from that one? And it's like
how you make them feel.
More or less the same. So it's just how you make them feel, how you stay top of mind, and it's a lot of subjectiveness.
Yeah. I feel like it'd be hard. You always hear about people going from resi to commercial. You never hear commercial to resi. So I feel like it's probably a tough.
That's a good point.
Because I guess if you're so used to the quick, like, all right, do the numbers work and stuff, to have to now throw that out the door and then go the emotional side.
Right.
It's probably tougher.
Yeah. I think that I can't think of anyone that went the other way. Yeah. Now that you say it.
Yeah, no one ever goes the other way.
Right.
Yeah. That's cool though, man, the residential stuff.
Yeah.
I always wish I did it when I was in New York. I was like, man, maybe I should get into residential just to feel New York real estate. But then I'm like, well, why wouldn't I just do multifamily in New York?
Right.
Even to this day, I'm still thinking like, man, do I want to just... Because so one thing I was thinking about with the deal sourcing guide I have in the course now. So I have like 8 people in it. And like I'm getting good questions. But one thing I thought would be a really good... And this would be both to build my skills and also to build more confidence in the group, was if I just left mobile home parks and did like a year in a totally new asset class and show that I could get like 5 listings in like 3 months and prove that my systems work.
Okay, I mean that when it
But
comes,
it's not worth my time to do that because I'm
Exactly.
so deep in mobile home parks now. Like I can make 2 calls and get
Yeah.
decision makers. But
Right. Yeah, and I almost think that like you're too well established for that to make sense for your
Yeah.
investment.
yeah,
Because like I would almost double down on mobile home parks, be the best that you
Yeah.
can be, and like build out your brand that way. That way, like, I mean, look, Pace Morby, right? Creative financing. He's like the sub 2 guy. Everyone
Yeah.
knows him. And, like he didn't like try to go to different niches, try different techniques and stuff, and
Yeah.
he just chose that one and he ran with it. So I think consistency helps a lot, especially when it comes to like just your brand.
Yeah.
Like people can get behind you, and I will say that like when it comes to choosing your business avenue, it's not so much like which avenue you take, but just more so sticking with whatever avenue that you're
you
in.
go down. Yes, that way you have the years and
You can learn to love anything, you can get good at anything, but the answer is just like get consistent with it, be better than others, put in your best work, and just the rest will fall into place.
Yeah. Do you see yourself in mobile home parks long term?
No.
Yeah.
No. So I mean, for me, like back to the earlier question. So, I'm going about this to be focused, and I want to build out systems that is replicable to other asset classes.
Yeah.
So for us, like definitely, like for now, large part is mobile home parks. We want to get really good at this, but then later on we might expand into like RV parks, self storage, something like that. Maybe even businesses. Honestly, depends.
Yeah. Have you guys talked to Nick Marsh at all?
Nick, I've heard of him, but haven't spoken.
Okay.
with him.
He's a younger guy, but he was on the. Probably shouldn't say on camera. He's like that front acquisitions guy for someone that we both know.
Oh yeah.
But he's bought out. He went off on his own. He's still doing that too. But
Sure.
I think he went off on his own and bought a few self storage on
Cool.
his own. So he's another young guy. That's like
Right.
I like connecting the younger guys in the industry because mobile home
For
parks
sure.
old industry. So it's like I like
Real estate in
connecting the
general,
young
man.
guys. Yeah.
It's an old industry. I think there's a lot of industries out there that it's like not sexy enough.
Yeah.
So like the trades, man. Like there's either like old 60-something-year-olds or like just like the young guys, the 20-something-year-olds that went into it for money.
Yeah.
Truckers, like Walmart's paying you 6 figures to be an 18-year-old truck driver. It's crazy.
Yeah.
There's no in between. So I mean, this is like one of those fields like you don't really see a lot of people in between.
Yeah, definitely not.
Yeah.
Why do you live in New York, by the way? It makes no
Great
sense.
question.
Like I moved out of here because I'm like, all right, if I wanted to hire someone, it's more expensive here.
Yeah.
I was doing the whole I still live in Florida thing, so I didn't have to worry about taxes.
Yeah. That's right.
IRS, just kidding.
That's right.
I was in Florida the whole time. 181 days I was in Florida, baby.
That's right.
And then,
Yep.
yeah, so that's why, well, and just the increased cost of living, but you don't seem like the bar.
Yeah.
You don't seem like you're hanging out at bars till 4
Right.
o'clock on
No,
Fridays.
no,
Yeah, you don't have that problem. But
So yeah, right. So I think that
yeah, well, I still live here.
for sure. Financially doesn't make sense, right? Like doesn't make sense. But I'm on board. Okay, so first off, like my girlfriend lives here, works in the city, makes sense. But also that like when you're going about something like business, it's like chicken or the egg. You need experience to have a job, or like job to have experience. So for me, it's like, okay, I'm going to make that upfront investment into being in this location where I can have like a world-class network, so much money, and like people like going after their dreams. Like that energy is like infectious, and to be a part of like so much history, culture all over. That to me is worth it, because then like that would put my mind in the right frame to succeed in business, as opposed to living in, I don't know, like Boise, Idaho, like little like
you network good though. You network good.
Oh, thank you.
Yeah, like I feel like you're good at the having conversation.
Yeah.
Where do you even network though? So like the problem I had in New York too, and this is like personal talk. Guys.
Sure.
Click off if you don't like it. I was like, even though I was always around people here, I felt almost more lonely. Now I didn't have a good group of friends because being new in the city, I had different friend groups, right?
Yeah.
I had these guys that were kind of real estate guys.
Sure.
And I had this guy who's like in fashion. This art girl, this
Yeah.
guy who's just total fuck up of a friend. Like, so it was like I had all these random friends. I didn't hone into like a good friend group, but that's just not being here long enough. I think. But like, where do you even network with people? Because now you're not even with an office or
Right.
anything. And that was the problem I had. I'm like, all right, well, one thing I wish I joined a WeWork, because that way I'm just around other independent entrepreneurs. So it's like, okay, I can meet you and what you're into, learn about what you're, just business people.
Right.
But like you being completely lone wolfed, and then you're actually a little bit like outside of like the main just popping areas. So
right.
Where are you kind of making friends and kind of networking? But I know you're from up here too, so
right. So
just the Northeast in general, but.
Yeah, I think that's a great question, man. And like, man, you have a knack for asking great questions, by the way.
Oh, thank you.
Yeah. So for me, like, I am similar to you. Like, I'm sort of all over the place. I think fundamentally, I'm comfortable with being with myself. Yeah. And like, I don't need others to like fulfill me or anything like that. So I think with that as a base, everything else is a plus. Yeah. And like, I don't say no to situations, or like, I'm open to possibilities. Like, I've had friends who are artists, photographers, like finance people, like all over the place, tech, whatever. Yeah. And that's just the beauty of the city. That's what I enjoy, in that like so many different kinds of like people in all walks of life can get together, sort of be together that way. And like, I get that constant diverse perspective, so I can approach things differently. Yeah. So I like that personally because of that. And networking, like, I don't, honestly, like, I haven't honed this in yet, because I mean, I've only been here since like about a year-ish ago. So I mean, largely like, honestly from LinkedIn, and then just meeting down in person. He's like, oh, you're in the city too? All right, let's grab coffee. Yeah. That kind of deal. Yeah.
That's cool.
Yeah.
Yeah. Instagram's definitely connecting a lot of people too. Mm-hmm. I mean, we basically met through, I mean, not Instagram, but no, we met through like the deal though.
Right.
Yeah.
I saw your vlogs before though, so like, really? I guess like, well, I got onto your list, and then, I saw your videos through the list.
Okay, so you probably got on my list through Crexy.
Maybe, yeah.
Because Crexy is where I'd get random. By the way, Crexy is a cheat code that I used to think was a waste of time. Very powerful.
Yeah.
Very powerful. Just because
it's like the Zillow of
it automatically generates leads for you without, like, on its own accord. I actually think it's a very undervalued
totally
system.
Yeah.
Interesting enough.
Yeah.
Well, dude, this was good.
Yeah,
I enjoyed your insight and everything, man.
Yeah,
Thank you for coming on the show and everything.
Thank you, Armand.
All right, if you guys want to check out Leo some more, you have social media handles, LinkedIn, anything you want to give them.
Yeah,
it's everything your name, Leo Young.
Just drop it on the description.
Bio, description below.
Yeah.
Appreciate you guys watching, and then we'll have an update once he's hopefully closing Shady Acres. We'll be doing another podcast. So.
Let's do it.
All right, thanks for watching.
All right, thanks, guys.